These 8 businesses are a wonderful place to start if you're searching for stable, high-yield dividend stocks or a clever approach to increase your nest egg. Hey there, in this video I'm going to show you 8 stocks that are paying out big dividends right now. You don't want to buy to hold for a year. You don't want to buy with the idea that you can sell it in 2 years or 3 years, necessarily make money. You could move money that way. But if you buy it for 10, 20, just keep buying the SP 500 index and forget about all the other nonsense that's being sold to you, because I'll guarantee you one thing about the stuff being sold to you: it will carry bigger fees, and I'll call you a come on. You could easily make over $1,800 every month if you owe just a couple of these stocks. With that kind of passive income, who wouldn't want it? Let's talk about dividend stocks and why you might want to buy them before we review the video. Dividends are payments provided to shareholders from the earnings of stocks that pay dividends. In tough economic times especially, this might be a terrific method to make money. But not all dividend stocks are created equal. Some investments offer significant yields and dependable dividends, while others can be a little tricky. Now I know what you're thinking. How do you know which ones are worth investing in, and what should you look for when choosing a dividend stock? Do not adopt me when I state that they are reliable businesses with a lengthy track record of giving out wholesome dividends. So if you're looking for a stable stream of income, then keep watching, because I'm about to reveal them all. Let me give you a figure that'll blow your mind. I think it was the first quarter of 1942, shortly after Pearl Harbor. I spent $114.75. Create 3 shares, $114.75. If I put that $114 into the SP 500 at that time and reinvested the dividends, think of a figure that might be worth the day. I just want your audience to think for a second. The answer is about $400,000. So if I was a little kid to take it out, $114, I'd say the shoveling snow or whatever I've done, $400,000 today. One person's lifetime. That's America. That isn't me. That is the huge tailwind the American economy gives to any equity investor. Now the market's going down many times during that time. People are panicked during that time. Headlines have been terrible. It looked like we were losing the war. First one. But America is a powerful economic machine that since 1776 has worked. It's going to keep working now. 1. J.P. Morgan Chase Company. We're going to be talking about J.P. Morgan Chase Company. Now this is the largest bank in the United States and the financial services company, the world's largest bank by market capitalization and the 5th largest bank in the world in terms of total assets, with total assets of $3.774 trillion US. It pays out a dividend yield of 2.93%, which is not too shabby. And with over $400 billion worth of market cap, you're guaranteed reliable income with these shares. But why exactly should you consider investing in J.P. Morgan Chase Company? Let's examine some of the elements that make it such a fantastic option. J.P. Morgan Chase Company is a pretty steady business for starters. It has a lengthy history of success, but is probably going to go out of business for a while. This makes it a particularly secure choice for investments. 2. J.P. Morgan Chase Company is now doing well. In addition to the corporation producing more money than ever, stock prices have been growing. So J.P. Morgan Chase Company is a wise choice if you're seeking a reliable investment that will yield decent returns over time. Finally, J.P. Morgan Chase Company is also very affordable. The stock prices are quite reasonable, and you can get in on the action for as little as $80 per share. Therefore, J.P. Morgan Chase Company is a company to think about if you're seeking a safe, dependable, and affordable investment. I've been taught by Ben Graham to buy things on a quantitative basis. I've been taught by Ben Graham to look around for things that are cheap. I was taught that, say, in 1940, and after that, they made a big impression on me. I went around looking for what I call cigar butts of stocks. The cigar butts approach to buying stocks is that you walk down the street and you're looking around for cigar butts. You find this on the street, this terrible looking, soggy, ugly looking cigar. You're looking around for one puff. Disgusting, but it's free, it's cheap. Then you look around for another soggy one puff. Well, that's what I did for years. It's a mistake. Although you make money doing it, but you can't make it with big money. It's so much easier just to buy wonderful businesses. Now, I would rather buy a wonderful business at a fair price than a fair business at a wonderful price. You really want to be in a wonderful business because the time is the friend of the wonderful. business. You keep compounding and it keeps doing more. 2. ExxonMobil Corporation. Now let's look at ExxonMobil Corp and why it might be a good investment for you. One of the biggest oil companies in the world, ExxonMobil offers owners a staggering 3.18% dividend payout. So ExxonMobil is a company to look at if you're searching for a reliable investment in the energy industry. With a market cap of $400+ billion, you can be sure that your investment is safe and stable with this energy giant. Why should you invest in ExxonMobil? Any investment involves a chance that the business will fail or the market will crash. However, by making an investment in ExxonMobil, you're helping one of the most dependable companies in the energy sector that has been in business for more than a century. When it comes to advantages, ExxonMobil's consistent dividend yield outperforms most other payouts. ExxonMobil has maintained a dividend payout even during periods of inflation or recession. 3. Main Street Capital Corporation. One of the market's highest dividend-yielding stocks is Main Street Capital Corporation. But is your investment worthwhile? First, consider Main Street Capital Corp's revenue sources. The organization has a very secure and reliable business model that focuses on debt finance from middle-market companies. This means that you can rely on Main Street Capital Corp for reliable cash flow year after year. What about the dividend yield? Is it as good as it appears? First and foremost, keep in mind that a high return does not always indicate a wise investment. It's crucial to examine the company's foundation and make sure its revenues are long-term. Main Street Capital Corp is currently performing quite well. The business's profits have been steadily rising and its outstanding dividend payment ratio is currently around 80%. This shows that the business can produce adequate cash flow to cover dividend payments, without significantly straining its balance sheet, those of its diversified portfolio interests, which includes renewable energy and real estate, and gives you plenty of flexibility and possibility for growth. Main Street Capital Corp is a solid option for dividend investors overall. The business model is robust and the company has a high return while paying dividends at a constant rate. Therefore, Main Street Capital Corp is undoubtedly a company to take into consideration if you're searching for a consistent income and long-term growth potential. For Union Pacific Corporation, are you looking for a stock that can provide you with stability and long-term growth? You should seriously consider investing in Union Pacific Corporation. UP pays out almost $1 billion in dividends to investors annually, with a dividend yield of 2.44%. But what makes Union Pacific such a great choice? First, the company is one of the largest and most dependable railroads in the United States, operating in over 40 states. That means Union Pacific is a safe bet for investors seeking stability and growth. Union Pacific is a fantastic investment because of its heritage and strong financial performance. Over the past 5 years, UP has seen a steady rise in net earnings. With a payout ratio of just 48%, Union Pacific also has plenty of room to raise dividend payments in the future. So, Union Pacific is a great choice if you're looking for a safe, reliable investment with great potential for growth. But we both kept learning all the time so that the man we were 5 years earlier was less sensible than the man who ultimately was there. And See's Candy did teach us both a wonderful lesson, and it will teach you a lesson if I tell you the full story. If See's Candy, it asked $100,000 more. Born and I would have walked, that's how dumb we were at that time. 10,000 more, and one of the reasons we didn't walk is while we were making this 1-year-old decision, we weren't going to pay a dime more. Remarshall said to us, "You guys are crazy. There are some things you should pay up for. You're underestimating quality." Well, Warren and I, instead of behaving the way they do in a lot of places, we listened to the criticism. We changed our mind, and that is a very good lesson for anyone. The ability to take criticism constructively is well, think of all the money we made for accepting that one criticism, and if you count the indirect effects from what we learned from buying See's, you can say that birdie's been built partly by learning from criticism. 5. Waste Management Incorporated. Waste Management Incorporated is a company that specializes in waste management and recycling services. Its shares currently have a dividend yield of an impressive 1.58%, with over $60 billion in market cap. You can be sure that your investment is safe and sustainable with this company. As an investor, what does this mean for you? Waste Management Incorporated's net profits have recently increased, and even throughout the recession, they have continued to pay out dividends regularly. As a result, the business is a rather secure investment choice. Additionally, shares of Waste Management Incorporated are less prone to market declines than some other dividend companies, making them an all-around safer option. Overall, Waste Management is a great company with a track record of success and strong profitability. If you're looking for a safe and long-term investment option, Waste Management should be at the top of your priorities. 6. Air Products and Chemicals Incorporated, one of the largest producers of specialty materials and atmospheric gases in the world, with operations in several nations. With a market capitalization of more than $60 billion, and a staggering 2.1% dividend return to shareholders. Air Products and Chemicals Incorporated is a very successful company. It pays out up to 10% in double-digit dividends. This company is a fantastic choice for investors looking for steady returns because of its diverse selection of products and services, which continuously generates money. This is a great dividend stock, but there are a few things you should know before buying it. A fantastic business is Air Products and Chemicals. They have a lengthy history of giving out substantial dividends, and they have operations in several different nations. Even the best companies can have bad years. Air Products recently reported lower than expected net profits for the fourth quarter of 2017. Of course, a company's stock price can always go down in a recession or a market crash. Air Products is still a great choice if you're looking for stability. Their yield is currently 2.1%, much higher than government bonds yield. That's a fantastic track record, right? For more videos like this one, be sure to subscribe to our channel. If you found this video useful, don't forget to hit the share button. How about other dividend-paying stocks? Well, a lot of them carry a lot greater risk than Air Products. For instance, Coca-Cola offers a healthy 3% return, but its stock price fluctuates far more than Air Products does. The strong 5% return paid out by Darden Restaurants, the company that owns Olive Garden and other well-known restaurants, is outstanding, but its earnings are significantly more vulnerable to recessionary pressures. For income investors looking for a dependability in strong dividends, Air Products is a great option. So if you're considering investing in Air Products and Chemicals, keep in mind about the market downturns. 7. PPL Corp. For investors looking for consistent dividends in any market, PPL Corp., a utility company that provides electricity and natural gas across the nation, is a great choice. A dividend yield of 3.08% makes this stock's dividend one of the highest in the industry. Looking for a low-risk stock with a steady dividend? Due to its extremely diverse portfolio of energy, look no further than PPL Corporation. Well, let's take a look at PPL Corp. For example, for over 30 years, this corporation has been paying dividends. Comparing that to some of the other dividend equities available, it's quite impressive. Not just the yield should be taken into consideration. It would be better if you also took the business's net profits into account. Due to its extensive diversification, PPL Corp is less likely to suffer in difficult times. The business has kept on paying dividends to stockholders even amid economic downturns or stock market collapses. So feel free to check out PPL Corp as one of your investment options that are worth considering. 8. PepsiCo Incorporated. As one of the world's largest food and beverage companies, PepsiCo Incorporated is worth considering if you're looking for consistent cash flow from your investment portfolio. With a market cap of over $200 billion and an annual dividend payout exceeding $4 billion, this is one stock you won't miss out on if you're looking for a dependable, solid investment to add to your portfolio. PepsiCo is a company you have to take into consideration, but what does that mean for investors? Now let's take a closer look at some of PepsiCo's key players. The company now offers a 2.5% dividend return to start. Investing in PepsiCo today will likely result in annual returns of about 2.17%. And since PepsiCo has been paying dividends for 33 years, you can be sure that your payments will be reliable and consistent. What about inflation? Won't that eat into our earnings? Actually, no. Despite growing inflation rates over the past 10 years, PepsiCo has boosted its dividend payouts each year. The company's new profits have grown by an average of 8.83% per year over the same period. What does this all ultimately mean for the shareholders? Due to PepsiCo's established track record and consistent growth, the stock has avoided the infamous dividend trap. In other words, even through recessions or market crashes, the share price has remained largely steady. In light of this, consider investing in one or more of these top dividend stocks to boost your passive income. Whether you're just getting started or looking for more stability in your portfolio, these stocks will keep you moving in the right direction of financial freedom. Are you searching for larger investment opportunities? Watch a few of our videos from today. Which of these dividend stocks appeal to you the most? Please tell us in the comments section. To receive more financial advice, please subscribe to our channel. Enjoy your day and thanks for viewing. Cheers.